Greetings, Ed Denny here. Hope you all had a very good weekend. Our weather here has been pretty nice. We did have some of that Ian rain show up last week, but beautiful day today. Nice fall weather. Hope it's nice where you are. Invite you all to come visit in New York or live in New York. New York's, I like the four seasons. I enjoy them. And the weather is pretty good in that regard. The only problem in New York is high taxes and crime. Other than that, it's great. I just read this morning that the fellow who's running for governor on the Republican side lives in Long Island, and he had a shooting incident, just a criminal activity on his front lawn. Wasn't really aimed at him, but spooked the living daylights out of his daughter. So we have a problem, and we also have all these folks coming in from south of the border, and there's our mayor in New York City is talking about having to spend $1 billion to house them and educate them and all. It's a challenge for sure. And then I'm reading somewhere that the Biden administration on a stealth basis is continuing to build some of the wall down south. Anyways, that's not my forte. Talking about politics, and you can get lots of that on CNN and Fox News. So let's turn to what I'm supposed to know something about, and that's the economy. Lots to talk about. It's a little bit of a relaxing day today because at least the bond market's closed, so we're not getting the stock market spooked by what's going on in the bond market. This could be this is a spooky month, but because it's October and Halloween is coming, but before Halloween comes, on Thursday, we're going to have the CPI, and on Wednesday, we're going to have the PPI. And so everybody's nervous about those kind of numbers. One of our accounts, Ted, asked if I would focus on the inflation situation. So I want to do that in a second. And it is something that I'm working on for tomorrow, actually. But in this morning's morning briefing, I've really focused on sort of a review and update on how our Fed Chair Powell has morphed into Volcker 2.0. And the other Fed officials seem to be chanting the same, reading from the same playbook, which is Volcker 2.0. So I kind of discussed how we went from not too long ago in July, Fed Chair Powell was saying that there's a tremendous amount of, he didn't use the word tremendous, there's a lot of monetary tightening in the pipeline, and he realized that they had already increased interest rates quite a bit. This was in July, so we're talking about 225 basis points since March, and now in September we had another rate hike of 75 basis points. So 300 basis points since March is a very rapid increase in the Fed funds rate. Everybody says it's the highest since 1980, but in 1980, Volcker wasn't raising rates. He was just letting them go wherever the market wanted to take them. This is policymakers tightening very aggressively in a very short period of time. And as I've said before, it's not just the Fed funds rate, it's also QT2, the reduction in the balance sheet, which nobody really has a clue on what that is equivalent to in terms of a rate hike. I think it's at least a 50 basis point increase in the Fed funds rate. And then, of course, there's been this knock-on effect on the dollar, where the dollar index is up 17%, I think really just since the beginning of the year. And so when you factor in the QT2, the strong dollar, and the Fed funds rate, we're really talking about a very aggressively tight monetary policy. I think the Fed screwed up. They know they screwed up with this transitory notion on inflation. I think they know they screwed up maybe by being too woke about the mandate, where back in August of 2020, they decided to give more weight to bringing the unemployment rate down than to bringing inflation down. And they basically said we wouldn't mind if inflation goes up above our 2% target for a while because we've undershot it for so long. Well, be aware of what you wish for, because they got it and it's shot up pretty dramatically here. So it's really caught up with that 2% trend line. that they were trying to achieve since January of 2012. Obviously it's happened too fast in terms of inflation. And as a result, they've had to pivot from let's raise interest rates and then maybe pause a little while to see how things are going, which was the kind of party line back in July. Now, with Powell's Jackson Hole speech, the pivot was made towards let's just raise interest rates until we see definite signs that inflation is coming down, and there's no more talk about pausing. There was no more talk about a path between a recession and inflation, that they could get the economy to slow down with lower inflation in a path that didn't require recession. And suddenly, there's Max, suddenly talking about the likelihood that there will be some pain, and that they're now aiming to get the unemployment rate actually up. So everything changed pretty dramatically. In this morning's piece, I sort of raised the question is, well, now that they seem to be on a Volcker 2.0 track, are they also increasing the risk of a Bernanke 2.0, that is to say, financial instability? And the answer is yes, they are. So everything's pretty much on fast forward here. This whole business cycle has been on fast forward. We had this terrible recession in 2020 that lasted all of 2 months. We had this amazing V-shaped recovery that brought us back in terms of real GDP to where we had been before the pandemic in about 12 months. And then for a little while there, it felt like an inflationary boom. And then all of a sudden we're talking about stagflation. And now all of a sudden we're talking about the great inflation of the 1970s. And again, one of the accounts asked me to discuss that, and I will in a minute. But let's look at the charts that are relevant to today's morning briefing before I segue over to the other issue. And feel free to ask questions. John already asked the question about what if rent is the only weird component that's showing a real problem on inflation in coming months? How will the Fed respond to that? I'll be back to you in a second on that. But I'm going to skip this. Look, the Fed keeps talking about they are sort of the low end of restrictive now with the Fed funds rate. I beg to differ. Again, if you factor in QT2, you might be asking the question, well, where's QT2 showing up as a tightening of monetary policy? And the answer is in the mortgage market. We've seen a tremendous surge in the mortgage rate from 3 to 7%, not just because of the rise in the 10-year bond yield, but also because of the dramatic increase in the spread between the mortgage rate and the 10 years. So that's clearly the markets got the strong impression that QT2 was coming earlier this year. It was basically in the December minutes that came out on just January 5th. And some participants said they basically wanted to get out of the mortgage business. So I've been kind of joking around that, we used to have Freddie, Fannie, and Freddie. Freddie wants to be out of the mortgage business, so they're going to let their mortgage securities mature, and they want to be out of that market. So the mortgage market figured all that out, and look at what's happening here in terms of the housing recession. And housing matters a lot. It's not that big a sector, but it can swing pretty big, and it can have obviously impacts on things like housing-related retail sales. One of the reasons that residential investment was down sharply in the second quarter wasn't because of housing starts, but was because real estate agents weren't getting the fees on existing homes. I'm hearing one of the puppies walking around here. So here we have the mortgage applications versus new home sales, and we're clearly going into a very severe recession of the housing market. Powell paid no attention to home prices when they were going straight up. And now he seems to be paying no attention to the likelihood that they're going to go straight down. As a matter of fact, Fed Governor Waller gave a speech last week about monetary policy and the housing market. He basically focused on the rent component the CPI and why it might be troublesome and why he thought that over time it might be less troublesome. But he basically, said we're probably going to have a mild correction in the housing market. I don't think that's the case at all. So here you have existing home prices. In a matter of 2 weeks, they were up by 45. Let's do that again. Matter of 24 months, 2 years, they were up by 44% on a year-over-year basis. I think Max wants to go out. And then now they're still up 25.9%, but I think it'll be amazing if we're not going to see negative comparisons very shortly, given what we know is going on anecdotally. But we also have a very significant negative wealth effect. We've seen the S&P 1500, I think it's down from $44 trillion at the peak on January 3rd to about $33 trillion now. So there's been a significant negative effect. And by the way, the bond markets also have a significant negative wealth effect. We know that the ETF for the 20 years down 33%, a third since the beginning of the year. So there's a very significant wealth effect. My relatives are calling me up, asking what they should do. So maybe that's making a bottom in these markets, but clearly there's pain being felt here in a lot of individuals' portfolios. Meanwhile, the Fed is focusing on getting the number of jobs openings down, and they seem to be making some progress there. But the market had a pretty nasty sell-off on Friday because the payroll numbers were somewhat better than expected. The perception being that therefore the Fed's going to have to continue to raise interest rates until they get inflation down. The initial jobless claims remain very tight. The labor market just doesn't confirm a recession. By the way, I just saw Jackie Dougherty pass me some news this morning about, I think, MasterCard, and they've got some data on September sales, and they call them sizzling. Consumers still spending, and they showed that housing-related spending is down, or it's relatively weak, but anything experience-related, traveling, airfares, hotels, motels, apparently spending is very strong there. So we may very well see a weak retail sales number on Friday, but keep in mind that just means that consumers are pivoting towards spending in services. So we'll be watching this. I do think there's a potential here for price inflation to moderate more than wage inflation. So we'll get real wage gains, and that'll keep the economy growing. Again, I've said it before, if we get a recession here, it'll be the most widely anticipated recession of all times, which is probably why it's not going to happen. This is just some wishful thinking that wage inflation's peaking. And again, I want everybody to get big wage increases, but I want them to surpass price increases. And the only way that's going to happen is if productivity makes a comeback. As you know, I've been promoting the idea that productivity should be making a comeback, but I have to tell you, it looks as though the pandemic really has screwed everything up. And when you see the kind of turnover in the labor market, it's pretty hard to maintain your productivity when people are quitting and you have to hire new people all the time. So I think a lot of the craziness that's been going on here has been pandemic related. We're still seeing a lot of that, but I think as things normalize, we may start to see things normalize, easier to predict, and maybe less on fast forward. Let me stop the sharing here and now segue to that question I had from one of you about spending some time on inflation. And so I did spend, just by coincidence, obviously we're all thinking about the same thing in this business. So I did spend quite a bit of time researching, thinking about, with Debbie, about the inflation outlook and how the Fed is influenced by all that. That discussion with my co-author Melissa on that kind of stuff, my teammate. So let's look at the story here. Figure one, we're looking at this year, the S&P 500 versus when the CPI was released. So for example, September 2022 will be released on Thursday. So that's all that means. It's just an attempt to show you the what we all have just lived through, which is inflation's been the #1 issue. Related to that, of course, is how the Fed responds to inflation and what that does to interest rates. And that in turn has created problems for the valuation multiple. So we have had a bear market as the forward PE multiple has taken a dive. And we still have a lot of controversy about whether there's going to be a recession. And if that recession is going to occur soon, our earnings are going to take a dive. And if earnings take a dive, we know from previous bear markets, we got more problems ahead of us because then everything goes wrong. Revenues go down, profit margin goes down, earnings go down, and there's more downside for valuation. So the question of where we go from here is extremely important. I guess it's always important. But I'm still thinking growth recession. We don't fall into a recession so much as we just don't have much growth. And that means earnings go flat. They don't take a dive to the downside. And valuation multiples around 15 for the S&P 500 are fair value PEs, especially when you factor in that when you take out the magnificent 8 stocks from the S&P 500, you get a multiple of more like 13 and a half. But people are obviously getting very twitchy about the potential for recessionary kind of lows in the forward PE. We're kind of there with the mid caps. I mean, they've really taken a dive on the valuation multiples. Let's look at the inflation story relative to what's ahead of us on Thursday. So I think the consensus is that the core will be, that the headline CPI will be up 0.5%, and that the core will be up 0.2%. And this market is so twitchy that if the core is up 0.6, it could sell off. That's all it would take to kind of convince people that, well, we might still be having some improvement in gasoline, and maybe we're starting to see some improvement in fuel, in food, that we still have an inflation problem that's spreading beyond food and fuel. Well, let's look at that. We have seen gasoline prices come down. This is the retail price and the futures price. The retail price is available weekly. It's the pump price, had a little uptick there, consistent with this little uptick that we've had so far in the futures market. But the number that's coming up on Thursday is September. So we do know that gasoline prices continue to fall in September. What about food? Well, we'll look at, I think we're going to look at that in a minute. But before the CPI comes out on Wednesday, we're going to have the PPI, and I'll be looking at that very closely. It's not widely recognized that the PPI now includes something, components for personal consumption. I think they don't include rent, but I'll be watching that number on Wednesday, and I'll maybe send out a QuickTakes on it. But here's the CPI for the personal consumption, consumer price index. And then here's the PCED, and you can see that looks kind of toppy to me anyways. And here's the PPI, which looks very toppy. So it's come down pretty hard, but it's also higher. You can look in the past, these things were kind of tracking each other pretty closely. And I guess if you look at the blue line, more often than not, it tended to be a little bit higher than the CPI and the PCED. So let's see what happens in September's number, whether that continues to come straight down like this. My suspicion is that's what will be the case. And again, that doesn't include rent, which we'll discuss in a minute. So here's personal consumption expenditures, ex food and energy, and it's a slightly different story, but not that different. We still have the personal consumption PPI coming down quite hard. And again, the correlation was reasonably good and tight back here. But what spooked everybody back in September when the August number came out and kind of cemented September as a lousy month to be in the stock market, at least for this year. You can see that there was an uptick in the year-over-year percent change in the core CPI. And meanwhile, there was a slight uptick in the PCED, though again, they kind of look peakish to me. But let's on Wednesday see what that PPI does, and I'll report it to you in QuickTakes. Here's another item, personal consumption services. And you can see that, again, we've had this big drop in personal consumption services in the PPI measure. But the CPI just kept going up and up and up. And that's because of, largely because of the rent. But there's also this pesky health insurance component that we'll look at in 1 second. So we'll see how all that plays out. But meanwhile, looking at food and energy again, they tend to be commodity related. Commodity prices peaked in the midsummer. And most relevant for the consumer prices is energy, which again peaked in the summer, as did agriculture and livestock. They are ticking up again, but we're looking at kind of year-over-year percent changes. And if they kind of go sideways for a while with some volatility, that actually takes some pressure off the food inflation and the energy inflation. Now look at gasoline again. This time around, we're looking at the national retail price relative to the CPI. We finagled it so that the indexes are identical. So they pretty much can tell from the 4-week moving average of the weekly number that there's going to be another drop in gasoline prices in the number that comes out on Thursday. We also know that consumer durable goods, I mean, at least I got this right. I've been arguing that we would see a moderation in consumer durable goods, and the consumer durable goods was a major component of the inflation problem we were having. And that's working out reasonably well, where the consumer durable goods inflation rate on both the CPI and PCED basis has come down. Look at this, one of the major components of durable goods that just went crazy is used car prices, and you can see that's moderated quite a bit on the CPI basis. And the CPI and PCED car prices, used car prices tend to be identical. Not all, that's not the case for quite a few indexes. But anyways, the Manheim index of wholesale prices, used car prices, you can see is down to 0 on a year-over-year basis. So that's encouraging. Looking back at the August numbers for durables and comparing them on a year-over-year basis to the 3-month, you can see that the new car price inflation is still high at 8% at an annual rate, but it is showing that there's a good chance that the year-over-year will continue to moderate. Well, not really the same, but yeah, I guess sort of the same. The 3-month for used cars and trucks came in at 4.4, but the yearly percent change came in at 7.8. And then here's furniture and bedding, same thing. And major appliances, anything housing related, furniture and appliances, we're seeing some disinflationary, deflationary forces. Now let's look at some of the services. In the services area, I just told you that Jackie told me that the MasterCard data for September shows sizzling retail sales, but that's not just for goods. It's for whatever people charge, and they're charging a lot for experiences, a lot for airfares and hotels, motels, and so on. And so you can see even in the August data that the 3-month lodging away from home was minus 21.6 at an annual rate, and the year-over-year is 4.1. So that could certainly continue to moderate. Airfares, ditto, minus 54.8 for the 3-month annualized, where the yearly percent change is 33.4. So that could certainly come down. And look at car and truck rentals, minus 47.6 versus a year-over-year of minus 6.2. Now let's go to that other service, which is important, and this is medical care services. The drug inflation is in the goods or the commodity side of CPI. It's not doing anything particularly major, but let's look at the medical care services, and you can see that the CPI is up a lot. It's partly hospitals. It's not physician services, but a lot of that is health insurance, as you can see. And you can see there's a huge discrepancy in both hospitals and in particularly health insurance between what the CPI and the PCED show. And the CPI is out-of-pocket expenses of urban consumers, where the PCED reflects the fact that health insurance is to a large extent picked up by employers, and that a lot of hospital fees are subsidized, picked up, or some ways regulated by Medicare, Medicaid. I don't know if it's going to get much worse on the health insurance side. As an employer, I know full well that what's going on with that blue line at the bottom of this panel. Now, rent is the big pain, and rent we know is a funky item here. And one of the questions John asked me about was rent. What if we get into the next few months and we find that everything really is moderating except rent? Will the Fed recognize that it's funky? I think they will. I think they know that it reflects all outstanding leases that are enforced right now. I think they know about this, that there's a rent component that Zillow shows for current leases, and that's got terribly inflated. And so with a lag, that's going to be reflected in the rent of primary residence and in this very funky owner's equivalent rent. I'm a homeowner, and they're telling me that if I was my landlord, I'd be paying myself more rent. And I don't know, nothing's really changed in my life, other than maybe my home isn't worth as much, but I wasn't intending to sell it anyway. So this is, statistically, it makes sense that they needed to have to show that housing generates some sort of services, but it's very funky indeed. I think there is a disinflation in the pipeline here. You can look at this on your own. This is figure 16. Look at it this afternoon or tomorrow morning, and you'll see that there is disinflation in the goods pipeline. And that's partly because the supply chain is problems that are easing. This is an index that's put together by the Federal Reserve Bank of New York, and you can see that supply chain issues have moderated really quite significantly. And that includes the PPI indexes for prices paid, includes the Baltic index and all that. So it's pretty comprehensive. And this is what you're seeing in the ISM prices paid indexes. Again, we're looking at the prices paid index for manufacturing. And in the morning briefing that I'm working on today for this afternoon, tomorrow, you'll see a discussion about, well, this is kind of the important thing is, look at this great inflation, the prices paid index was all over the place, but it was on balance really high. Look at this experience so far. Maybe it's just the beginning of a great inflation up ahead here, but I don't think so. So that's it. Let me turn off the sharing, is caring, and see. Okay, so John, I answered your question, I hope. Lewis, when Biden stops releasing crude oil from the SPR, will crude oil prices rise further? It's a good question. It looks like he wants to keep pumping it out right to the election, trying to make people happier coming up to the election. We'll see whether he has any success at that. But I would say that the thing I'm watching is actual usage. And usage of gasoline in the United States is down 1 million barrels per day compared to a year ago when you look at the weekly series. So OPEC's cut back to a large extent because global demand has slowed. I don't really think that oil prices are going much higher. I don't think gasoline prices are going much higher. I mean, people really are cutting back on their usage of fuel, even though the prices come down. Meanwhile, they're continuing to have to pay high prices in other areas, like in the grocery store. So I think they're still going to be fairly conservative, but we'll do some more work on that. I did some work a few weeks back on the Strategic Petroleum Reserve and came to the conclusion that it was basically a drop in the bucket when you look at it in the context of global oil demand and oil supply. But it's a little bit more than that within the US. But again, I think it's been more, we've seen this big drop in, there he is again. Just wandering around. Usually he sleeps this time of day. Okay, let's go to Bing. I don't seem to recall a time where real rates from 10 years all the way to the Fed funds rate have been negative outside of a recession. with monetary policy still so accommodative, would it be wrong to say that this might mitigate the effect of such a rapid increase in interest rates? It's a good question. Clearly, if you look at the inflation situation relative to yields, yields need to go a lot higher to catch up with inflation. But on the other hand, inflation could also come down to catch up with bond yields, and they could meet somewhere. I think that the 4 years, the 10-year is going to stay around 4%, maybe with some volatility. It does look like the Fed is aiming for a terminal rate of 4.5 to 4 3/4 on the Fed funds rate, and that means that the 2-year can go higher, but that also means that the yield curve could remain inverted with the 10 and 2-year inversion. As the bond market increasingly anticipates that if the Fed continues to be this tough, that something might very well break. You may or may not agree with that, but that's what the bond market seems to be saying. We always get inverted yield curves during monetary tightening cycles, and it gets more inverted the more you get near the tail end of the monetary tightening cycle, as the yield curve correctly anticipates that something will break. It's done that in the past. It could do that again now. And a lot of things come to mind, like the soaring dollar creating problems for emerging countries, like breaking the housing market with a continuing collapse in mortgage applications, leading to falling home prices. At least calls coming in. Well, we're almost done. Let me just turn off that noise. Okay. Why can't inflation stay higher for longer? Consider the following. Yeah, then there's a whole bunch of reasons why it could, and the answer is it could. It does kind of wake me up in the middle of the night when I have my nightmares remembering what happened in the 1970s, and inflation turned out to be persistent and lasted a long time, and we just kept having these PPIs of 1% per month, not annualized, 1% per month, 1 month after another, without any let up. But look, I just went through an explanation of why I think inflation's coming down. Try to be data dependent on that, and I think I made a fairly convincing case that we could have quite a bit of disinflation, with the one exception of rent and maybe healthcare, health insurance. But other than that, things look like they're moderating. I'll take one last one. Any thoughts on whether the U.S. dollar has moved high enough to negatively impact the U.S. corporate sector? Yeah, I think in the third quarter announcements here, the reports, we are going to hear companies tell us that the dollar has depressed their earnings, and for some of the multinationals, that's going to be a significant impact. But on the other hand, the data just doesn't show a recession so far. As a matter of fact, the Atlanta Fed's real GDP is tracking at 2.7% for the third quarter, and some of these other indicators of sales in September are looking pretty good. Well, look, have a great week. Let's see how these PPI and CPI numbers play out. We'll keep you posted on our thinking with QuickTakes and other means of communicating with you. Thank you for tuning in.